You paid off your house. The most significant financial milestone most people will ever reach. And nobody tells you that the morning after, you feel almost nothing. Most finance channels will celebrate the payoff with you, tell you to cut up the statement, do a little debt-free scream. What they don't tell you is what comes next. The cash flow recalibration, the tax surprise, the identity shift. The very real danger of turning the biggest financial win of your life into the beginning of a new kind of stuck. I've walked dozens of clients through the 90 days after mortgage payoff. The pattern is almost identical every time. The people who got it right made 3 specific decisions in a specific order. The people who got it wrong made one very common mistake within the first 6 weeks. Stay with me, because what I'm about to show you changes everything. By the way, if you're new here, my name is Alex Carter. I've been working in personal finance for 8 years. In these 8 years, I've helped hundreds of people solve real money problems. And honestly, some of those people's lives completely changed because of it. On this channel, I help everyday people navigate the financial moments that actually matter, including the ones nobody prepares you for. All right, let's get into it. Let me start with the part nobody talks about because it feels ungrateful to admit. My client, I'll call her Sandra, made her final mortgage payment on a Tuesday in March. She had worked toward this for 11 years. She and her husband had lived below their means, skipped vacations, driven older cars, said no to things that their friends said yes to. All of it pointed toward this moment. She called me that Thursday. And the first thing she said was, "I thought I'd feel more than this." That emotional anticlimax is real, and it is almost universal. You spend years building toward a milestone that exists primarily as a number on a statement. And when the number reaches 0, the house looks the same. Your life looks the same. The feeling of freedom you expected doesn't arrive on schedule. That is completely normal. And it passes. But the financial decisions you make in the weeks immediately after while you're in that liminal space between what you were working toward and what comes next, those decisions have consequences that last decades. Here's where it gets really interesting. The first thing that changes after payoff is cash flow. And the change is bigger than most people emotionally process in real time. The average American mortgage payment in 2026 is approximately $2,200 per month. When that payment stops, you suddenly have $2,200 per month that was previously allocated, automatically, non-negotiably, to a fixed financial obligation. It is no longer leaving your account. And if you do not immediately and intentionally redirect it, it will find somewhere to go on its own. It always does. This is the most common mistake I see in the first 90 days after payoff. Not recklessness, not irresponsibility, just a quiet, gradual absorption of that freed cash flow into lifestyle. A nicer dinner out, a home renovation that wasn't strictly necessary, a trip that felt deserved, none of it dramatic, all of it permanent if the pattern sets. The freed cash flow from a mortgage payoff is the single largest financial reallocation most people will ever experience outside of an inheritance. Treating it like a raise that gets spent is the most expensive version of that mistake. Keep watching because what comes next is the part most people never figure out. The second thing that changes, and this one blindsides people who weren't warned, is your taxes. If you were itemizing deductions and claiming the mortgage interest deduction, that deduction disappears the moment your mortgage is paid off. The average homeowner in the final years of a 30-year mortgage is paying approximately $4,000 to $8,000 in annual mortgage interest. At a 22% marginal tax rate, that deduction was worth $880 to $1,760 in tax savings per year. When the mortgage ends, so does the deduction, and your taxable income quietly rises by a corresponding amount. Most homeowners discover this at tax time, which is not a crisis, but it is a cash flow adjustment that needs to be anticipated rather than discovered. The practical fix is simple. Increase your W-4 withholding or your estimated quarterly payments by the amount your tax liability is likely to increase. The number is real but manageable when you see it coming. The third thing that changes is something your mortgage was doing quietly on your behalf that you may not have fully noticed. Escrow. Most mortgages include an escrow account that your lender manages, collecting a portion of your monthly payment and holding it to pay your property taxes and homeowner's insurance when they come due. When your mortgage is paid off, escrow ends. And those bills, which could total anywhere from $3,000 to $12,000 or more per year depending on your location and property value, are now your responsibility to anticipate and fund directly. I have seen fully paid homeowners hit with a $7,400 property tax bill in October that they genuinely were not mentally prepared for, not because they didn't know property taxes existed, but because escrow had been handling the logistics for 30 years, and the muscle memory for planning ahead wasn't there. The fix: open a dedicated account immediately after payoff and begin depositing 1/12 of your projected annual property tax and insurance total every single month. You are essentially running your own escrow. The bill stops being a surprise and starts being a scheduled transfer. Okay? I'm going to show you something in just a minute that took me 2 years to learn, but first, let's talk about the wealth acceleration question. This is the part most people completely miss after payoff. Paying off your mortgage made you significantly wealthier on paper. If your home is worth $400,000 and you just eliminated the remaining balance, your net worth just increased by that entire balance in a single moment. That is real wealth creation. It deserves to be acknowledged. But here is what it didn't do. It didn't make you liquid. Your home equity doesn't generate monthly income unless you extract it. Your net worth number went up dramatically, but your ability to cover unexpected expenses, fund retirement, or create flexibility in your financial life did not automatically improve. Many fully paid homeowners are asset-rich and cash-poor simultaneously. They own their home outright. They have little in liquid savings. And if the furnace fails, if a medical bill arrives, if income is interrupted, their theoretical net worth provides no immediate protection. The transition after mortgage payoff is from debt elimination mode into wealth acceleration mode, and the order in which you execute that transition matters enormously. Here is the priority stack I walk clients through. First, fully fund an emergency reserve. Before anything else. 6 months of true living expenses in a high-yield savings account, accessible without penalty. Now that you no longer have a mandatory mortgage payment, your monthly expenses are lower, which means this reserve is smaller in dollar terms than it would have been before. Build it first. It is the foundation everything else sits on. Second, address any remaining high-interest debt. Credit cards, personal loans, car loans at 7% or higher. The freed cash flow from your mortgage goes here next, systematically and completely. Third, maximize tax-advantaged investment accounts. 401k to the employer match minimum, then Roth IRA if you qualify, then back to the 401k to the contribution maximum. In 2026, the combined 401k and IRA contribution limit allows most individuals to shelter $30,500 or more per year from taxation. Many former mortgage payers have never been able to fully fund these accounts because the mortgage consumed so much of their monthly cash flow. That constraint is now gone. This is the window. Okay? Fourth, and only after the first three are established, direct remaining freed cash flow toward taxable investment accounts, additional asset building, or discretionary lifestyle upgrades. In that order, not reversed. The identity shift that happens after payoff is real and it matters. For years, your financial identity was organized around eliminating a liability. Now the liability is gone and the question becomes, what am I building toward? That question needs a deliberate answer. Because the absence of a mortgage does not automatically create financial direction. It creates financial freedom, which is only as powerful as the intention you bring to it. You worked incredibly hard to arrive at this moment. Don't let the absence of clear next steps turn the biggest win of your financial life into a pause. You have agency, more than you've had at any point in your financial life, and now you know exactly what to do with it. All right, so today we covered the financial, tax, and psychological realities that follow a mortgage payoff, and the exact decision stack that turns freed cash flow into genuine wealth acceleration. If this helped you even a little bit, hit that like button. It genuinely helps this channel reach more people who need this kind of content. Subscribe to the channel and make sure you hit the bell icon so you never miss a video like this. We drop new finance content every week, and trust me, you don't want to miss what's coming next. And if you want to go even deeper on how to build an investment portfolio that makes your paid-off home work harder for your financial future, I've linked a video right here. Go check that out next. I'll see you there. Have a prosperous day.